In the questions that we have attempted so far, the cash flows were directly given in the question. But the question that we are going to attempt today is where the cash flows are not directly given. So in this question, you have the sales given, you have the variable cost, you have the fixed cost, you have the depreciation. All these are given in different places. So we have to accumulate all these figures and then we have to find the cash flow. Only then can we find the NPV. Now, before we go to the question, there are certain golden rules of NPV that I want you to know. Okay, let's take a look. The golden rules for NPV. The first rule, include only cash flows. You might be wondering, what is the big deal? Yes, we should include only cash flows. But there is one item in the P&L account that appears as an expense, but there is no cash outflow taking place. Can you name it? The item is depreciation. Depreciation is an expense that appears in the P&L, but it is not a cash outflow. Okay, the cash outflow takes place only when the machinery is purchased in year 0. Exclude non-cash flows like depreciation. However, depreciation is considered for arriving at tax. So what should we do? As a cash outflow, we should not take depreciation. But for calculating tax, we should take depreciation. Include only incremental fixed cost. What do you mean by incremental fixed cost? Incremental means additional fixed cost. I will give you an example. Suppose you are having an existing business and that business is being run in a factory for which you are paying rent regularly. Okay. Now you are planning to start a new business and you are planning to utilize a part of that factory for the new business. Now the rent, the existing rent of this factory, should you include it in the NPV calculation for the new business? This is the question. The answer is no, you should not include because that rent is already being paid. Even if you accept or reject the new project, you will still have to pay the rent. So the existing factory rent should not be included in the NPV calculation of the new project. Only additional fixed cost. If you're paying any additional rent, yes, that has to be considered. But the existing fixed cost or the existing rent should not be considered. That is point number 2. Include only incremental fixed cost. Exclude the existing fixed cost. Question number 1. Charm Company has developed a game, Fingo. Details. There are 4 years and the first row is sales and production in units. The second is the selling price. Sales in units multiplied by selling price, you will get the sales in value. Financial information for the first year of production. Direct material cost $5.4 per game. So we can definitely find out the total direct material cost just by multiplying it with the number of units. Other variable production cost $6 per game. That also you can find out the total by multiplying with the number of units because this is per game. Fixed cost $4 per game. Okay, and the information relates to the first year of production. Just put that in mind. Advertising costs are expected to be 650,000 in the first year and 100,000 in the second year. No advertising costs are expected in the third and the fourth years. Fixed costs represent incremental cash fixed production overheads. That is this fixed cost that represents incremental, which means that these are additional fixed cost. So we have to take for NPV calculation because we studied one of the golden rules of NPV is to include only additional fixed cost. Fingo will be produced on a new production machine costing 800,000. So what is the investment? Investment is in year 0, there will be a cash outflow of 800,000. Capital allowances will be claimed on a straight line basis over 4 years. What do you mean by capital allowances? Capital allowances means depreciation. Depreciation is to be charged over a period of 4 years. The company pays tax on profit at a rate of 30%. So the tax rate is 30% and tax liabilities are settled in the year in which they arise. So the cash outflow for tax happens in the very same year. The company uses an after-tax discount rate of 10%. Required, calculate cash flows, calculate NPV and comment on it. So first we have to calculate the cash flows. Only then can we calculate the NPV. So first we will go to point A, that is cash flows. These are the question extracts. I have copied it into this slide so that it will be easier for you to compare it with the answer when I am working it out. So sales and production is given, the selling price is given, direct material cost per game is given, other variable production cost is given, fixed cost is given, and fixed cost represents the incremental fixed cost, which means that it has to be taken. So we will work out the cash flows in the form of a table. So we have the 4 years, 1 to 4, and we will write the amount in thousands of dollars. Sales. What is the sales figure? For the first year, we are selling 150,000 units and the selling price is $25. So what is the answer? It is 150,000 into 25. That will come under year 1, 3,750. That is in thousands of dollars. So we have omitted the 3 zeros. And for the second year, the sales is 70 into 24. That is in thousands. So you have 1680. In the third year, it is 60 into 23. So we have 1380. Everything I'm omitting the thousands because here we are writing it as thousands of dollars. And what about the fourth year? It is 60 into 22. That will come as a sales for the fourth year, 1320. Next item is direct material cost. So direct material cost, we know that it is $5.4 per game. So direct material cost for the first year, it is how many units are we selling? 150. 150 into 5.4. That will come for year 1. So it is 810. I'm indicating it in bracket because it is an expense. For the second year, it is 70 into 5.4, which means that it is negative 378 for the second year. And for the third year, it is 60 into 5.4, which is negative 324. And for the last year, it is 60 into 5.4, which is again negative 324. So we get direct material cost for all the 4 years. Next comes the variable production cost. Variable production cost is $6 per game. And how many units are we selling or how many games are we selling? For the first year again, it is 150 into 6. So the amount is 900 for the first year. For the second year, it is 70 into 6. So it is 420 for the second year. And for the third year, it is 60 into 6. So it is 360 for the third year. And for the last year, it is 60 into 6. Again, 360. So the variable cost is also complete. Next item is the fixed cost. Now, what do you mean by fixed cost? Fixed cost remains the same for all the years, right? It doesn't vary. So what have they based it on? They have based the fixed cost per game based on the first year of production. Based on the first year of production, the fixed cost works out to $4 per game. But fixed cost will not change. Fixed cost means, as the name indicates, it is fixed. So fixed cost, I will write it as working note 1. So working note 1, the fixed cost is constant. Given information is for year 1. So in year 2 and 3, 2, 3 and 4, it remains the same. So what is the amount of fixed cost? It is the first year of production. So it is 150,000 units into $4 per game. That is why I've indicated 150,000 into 4, which means that the fixed cost amount is $600,000. And that is not only for year 1, it continues for year 2, 3 and 4. So the fixed cost amount remains constant for all the 4 years. So I'm going to write here 600,000 for all the 4 years. So we have got the sales, the direct material cost, the variable cost and the fixed cost. I have copied the second part of the question extracts that is relating to the advertising cost and so on. So on the left hand side, this is where we have worked out till fixed cost. Now, what is the next item? Advertising costs are expected to be 650,000 in the first year, 100,000 in the second year. So we will key that figure in. So advertisement for the first year, it is 650 and for the second year, it is 100. No advertising costs are expected in the third and fourth years. So in the third and fourth years, the amount is 0. Fingo will be produced on a new machine costing 800,000. So $800,000, that is the cash outflow for year 0. Now, capital allowances. Capital allowances will be claimed on a straight line basis over 4 years. So I said the capital allowances is nothing but the depreciation. So depreciation, I will write it as working note 2. So in working note 2, we have the depreciation. What is the amount of depreciation? 800,000 is the amount of the machine. And we have to split it over a period of 4 years. So 800,000 divided by 4, because it's a straight line method of depreciation. So per annum, the depreciation is 200,000. We have to take this amount for calculating tax. So I will be writing depreciation in the table. So 200,000 for year 1, 2, 3, and 4. After that, we get the profit before tax. So what do? From the sales, we reduce direct material cost, variable cost, fixed cost, advertisement, and depreciation. And we arrive at the profit before tax for year 1 as 590, for year 2 as negative 18, for year 3 as negative 104, and for year 4 as negative 164. Now we will calculate the tax. What is the tax rate? Tax rate is at the rate of 30%. So tax at the rate of 30%. So it's 590 into 30% for year 1. So 177. And since it's a loss, we don't need to pay tax for year 2. So the tax is 0. And for year 3 and 4 also we are having a loss. So we don't need to pay tax for year 3 and 4 too. So we are having a tax amount of 0. So what is the profit after tax? Profit after tax is 590 minus 177. So you get 413 as the profit after tax for year 1. And for year 2, it is negative 18 minus 0. So it's again negative 18. And for years 3 and 4, it is negative 104 and negative 164. So we get the profit after tax. Now, the profit after tax is after considering depreciation. But I told you, depreciation is not a cash outflow. So what should you do? We should add back the depreciation to nullify the effect. So we are going to add back the depreciation 200, 200, 200 for all the years. This is what we have deducted. Why are we adding this back? We are adding this back because it is not a cash flow. Because we have already reduced it here. We should not have reduced it because we have to take only the cash outflows, and depreciation is not a cash flow. Why did we reduce it here? We reduced it here only for the purpose of calculating tax. Not for calculating cash flows. For calculating tax, yes, we have to take depreciation, but it should not figure in the cash outflow. That is why we are adding back the depreciation here. So what is the cash flow? So we get 413, add back the depreciation that we had already reduced. So we get 613 as the cash inflow for year 1. And for year 2, the cash inflow is negative 18 plus 200. So we get 182. And for year 3, we have negative 104 plus 200, that's 96. And for year 4, it is negative 164 plus 200. And the amount comes to 36. So we have the cash flows of all the 4 years, and the cash outflow for year 0 is 800,000. Okay, so we will just record what we have just found out. So these are the cash inflows from year 1 to 4, and this is the cash outflow in year 0. So we will just record it in amount and thousands. So we have year 0 to 4, so cash flow in year 0, it's 800,000. That's the cash outflow in year 0. And from year 1 to 4, I have just copied the figures that we have just found out. Now, if you compare our answer with the textbook answer, you will get these two figures. But there is a slight difference in the figures that we have calculated for years 2, 3, and 4. That is because there is a mistake in the textbook. And That mistake is because of the format that they have adopted. I want you to understand the mistake that is appearing in the textbook. Now in year one, if you see, what have we done to arrive at the cash flows? We have taken the sales and we have deducted all the expenses, including the depreciation, and then we have arrived at the profit before tax. Then we have calculated the tax at the rate of 30%. We arrived at the profit after tax, and we added back depreciation because that is not a cash outflow. And then we got the cash flow of year one. Now, if you see the textbook figure also, till advertisement, it is the very same figure. But in the textbook, what they have done is they have not reduced depreciation. That is, instead of reducing 200, they have not reduced it. They have taken that as 0. And profit before tax, they get it as 790. That is, the difference is 200 of the depreciation that they have not deducted. And they have calculated 30% tax on that. So they get a 237 as the tax. And then they get the profit after tax, that is 790 minus 237. They get 553. And in the next line, they don't need to add back depreciation like we did because they have not deducted depreciation. But the one thing that they have to take is they have to consider the tax savings on depreciation because depreciation is an admissible expense. And when you reduce depreciation, you get a 30% tax benefit on that depreciation. So what is the depreciation amount? Depreciation amount is 200. And what is the tax savings? Tax savings is 30% on 200. What is 30%? 30% is the tax rate. So 200 into 30% is the amount of tax that you save or that you do not pay because of depreciation. So that they have added it back. So that is nothing but 200 into 30%. This is what they have done in the textbook. And they will get the very same figure, 613 for year one. So year one is not a problem because we have a profit for year one. But in year two, I will show you the mistake that they have committed. So in year two, our answer appears like this and the text answer appears like this. So till advertisement, it is the same. They've taken the depreciation amount as 0 and then they have worked out the profit before tax, that is sales minus all the expense. So you get a 200 difference here. That is because of the depreciation. And what is the tax at the rate of 30%? Tax at the rate of 30% is 182 into 30%. That is how you get 55 as a tax. And then you get the profit after tax. Profit after tax is 127. And what have they done? They have to adjust for the tax savings on depreciation. What is the tax savings on depreciation? Depreciation is 200. So what is the tax savings? 200 into 30%. Just like they did in year one, they have added back 60 and they have got a cash flow of 187. Do you think this is right? What do you mean by tax savings on depreciation? It means we get a reduced amount of tax because of depreciation, right? That is the meaning of tax savings on depreciation. We don't need to pay a higher tax. Because of this admissible expense, we need to pay a lower tax. But what is the amount of tax that they have paid? The amount of tax that they have paid is only 55. Now listen carefully. When the amount of tax paid is only 55, how can the tax savings be equal to 60? You think that is right? 55 is the amount that they have taken as tax paid. Do you think that the government will refund the tax? No. Whatever tax savings is restricted to 55. This amount should have been restricted to 55. This amount should have been restricted to $55, which is equal to the tax paid. You can't have a tax savings on depreciation which exceeds the tax amount. That's just not logical. So that is the reason for the difference of $5 or $5,000, that is in thousands, between our answer and the text answer. Because the text answer is wrong, simply because they have taken a tax savings on depreciation which exceeds the tax amount. So their format will work only in case of profit, only in cases of years in which we are having a profit. In cases of years in which we are having losses, that is years 2, 3 and 4, we should not adopt this tax savings on depreciation. amount $60. You cannot add the entire amount of $60. You can add only to the extent of tax paid, that is $55. So this is the mistake that has been committed in the text. So whenever you see an answer in the text, apply the logic and understand whether what they have done is right. Whatever is written in the text may not be right. With this, we come to an end of part A of the question. Don't you think we have learned a lot? Don't you think you need a break? In the class, you people will all be shouting, we want break after each question. So let's take a break and continue part B of the same question in the next session. Thank you.